Welcome to The Explainer. What if I told you there's a stock market out there with a conscience? One where every company is checked not just for its profits, but for its principles. Well, today we're going to dive into exactly that, Malaysia's unique ethical market, and figure out how it all works. So let's just start with that big question. What if a financial market wasn't just about the numbers, but also about values? I mean, what if it had this built-in filter, right? One that screens companies based on their core principles. Well, that's not some hypothetical. In Malaysia, it's very, very real.
Okay, so how does this whole thing actually work? We're going to start by looking inside the Bursa Malaysia itself. Then, we'll get into this unique Sharia filter. I'll walk you through how that filter actually works step by step. And finally, we'll kind of zoom out and look at the bigger picture, why this all matters.
All right, first things first, let's get grounded. We're talking about the Bursa Malaysia, which is the country's main stock exchange.
If you just look at the surface, it seems like any other modern stock exchange. You've got different tiers for all kinds of companies, right? The big players on the main market, the up-and-comers on the ACE and LEAP markets. It's this busy hub with over 900 companies listed, trading everything from regular shares to things like real estate investment trusts.
But here's where it gets really interesting. See, underneath all that normal market activity, there's this powerful, values-based system quietly at work, an invisible layer that screens pretty much every company on the exchange.
And that system brings us right to the heart of what we're talking about today, the Sharia compliance framework. You could think of it as the engine, the thing that gives this entire market a conscience. And get this is a wild number. A staggering 84% of all securities on the Bursa Malaysia are certified as Sharia approved. So we're not talking about some small niche part of the market here. This is the vast majority of it.
So what does that even mean, Sharia compliant? Well, you can think of it as a kind of ethical purity test. There's this group of experts, the Sharia Advisory Council, or SAC for short, and their whole job is to screen companies. They filter out businesses involved in activities that are considered prohibited. Now, this includes the stuff you'd probably expect, like gambling or liquor, but it also gets into a really core financial principle, filtering out conventional banking that relies on interest, what's known as riba. The idea here is to avoid generating money from money and instead focus on money generated from actual, legitimate trade.
And here's the really crucial part. This list, it's not just about telling investors what to avoid. It actually becomes the foundation for an entire ecosystem of Islamic financial products. We're talking everything from unit trusts to stockbroking services. By creating this trusted list of approved companies, it really acts as a catalyst, sparking growth across the whole ethical finance sector. Okay, so you've got over 900 companies on this exchange. How in the world do they decide which ones make the cut? Let's break down how this filter actually works.
It's actually a super systematic 5-step process. Okay, so step 1, they start by digging into all the financial data from a company's audited reports. Then, they review all of a company's business activities. Next, they measure those activities against some really specific financial benchmarks. After that, everything gets presented to that advisory council we mentioned, and they make the final call. And then boom, the official list gets published for everyone to see.
Okay, so the first hurdle in this whole screening process is basically a numbers game. It's what we call quantitative. They're really zeroing in on two main things here. First, what does a company actually do? And second, how does it handle its finances?
So let's talk about the first big test. It's the 5% benchmark, and it is the strictest rule of all. This one applies to business activities that are just clearly fundamentally not allowed.
So, have a look at this list. We're talking conventional banking, gambling, alcohol, tobacco. You get the idea. If a company gets more than 5% of its total income from any of these things, it's out. Simple as that. It's a really clear line in the sand. That tiny 5% tolerance is really just a practical allowance for big, diversified companies where these things might be a tiny fraction of their business.
But not every business activity is seen as black and white. So there's another benchmark, a bit more lenient, set at 20%. This is for more of the gray areas.
This 20% rule kicks in for businesses where the main thing they do is totally fine, but there might be some non-compliant stuff mixed in that's kind of hard to avoid. A perfect example is a hotel, right? The main business is lodging, but it probably has a bar that serves alcohol, or a stockbroking firm. For these companies, the income from those gray area activities has to stay under that 20% threshold.
Okay, so that covers what a company does. But the screening doesn't stop there. Next, they look at how the company is financed, and this gets back to that really important principle of avoiding riba, or interest.
And to do that, they use two really important financial ratios. So check this out. First, they look at how much cash the company holds in regular interest-earning bank accounts. That number has to be less than 33% of its total assets. And second, they look at its debt. Any debt that bears interest also has to be less than 33% of total assets. A company's got to pass both of these tests. It's proof that it's not too tangled up in the conventional, interest-based financial system.
All right, so even if a company aces all of those number-based tests, it's still not over. There's one final check, and this one's a little different. It's a qualitative review. This is where the advisory council basically steps back from the spreadsheets and just looks at the big picture. What's the company's public image? What's its reputation? Is it generally seen as a good actor? You could have a company that passes all the financial tests with flying colors, but if it has a really negative public perception, it could still get booted from the list.
So, you have this incredibly detailed, multi-layered screening system right at the heart of a country's stock market. What's the actual, real-world impact of all this?
Well, the impact is pretty huge. For starters, it gives ethical investors a super clear roadmap. It also centralizes all the rules, so everyone is playing from the same playbook, which boosts transparency for the whole market. And, like we said before, it spurs the growth of new financial products. It even helps the companies themselves. Getting that Sharia-compliant stamp of approval can open them up to a whole new base of investors.
And if you think this is some niche market stuck in one or two industries, think again. Just look at this breakdown. These approved companies cover the entire economy. Industrial products and services alone make up more than half the market. You see consumer products, properties, it really shows that a values-based filter doesn't have to limit investment opportunities. It can reflect the whole diverse economy.
And in the end, it all comes back to this one simple, powerful idea. The entire structure is built on a commitment to principle. It's about finance with a purpose that goes way beyond just chasing the highest profit. Which leaves us with one last big question to think about. As we see more and more investors all over the world focusing on things like ESG, sustainability, and their own personal ethics, they're starting to demand more than just a financial return. So could this model that Malaysia has perfected actually become a blueprint for markets everywhere? It definitely points to a future where maybe every investment has to pass two tests, not just a financial one, but a values one too.